Good morning, everyone. I'm Vince Lancy. Today's market rundown, we'll be discussing oil's current situation and outlook going forward. We will also discuss the implications of oil's price behavior on precious metals, miners specifically. Let's start with the markets themselves. The dollar is 101.30, down 9. I'm sorry, up 9. Wishful thinking. Let you look at the charts there while we're doing that. 10-year yields are 376, up 3. S&P 500 is 5,700, down 5. The VIX is 19.38, up 11. Gold is 26.51, down 11. Silver is 31.46, up 3. Copper is 460, up 4.75 cents. That's a percentage point. Gold, silver a little lower, working out of that channel very nicely now. WTI 72.79, up a buck 24, very strong. Natural gas 272, up in sympathy, although it's really not related, up 7 cents. Bitcoin 61,000 and change, up 458, continues to bounce after its significant sell-off. Palladium 1,011, up 6. Platinum 998, up 5. Okay, that market's pretty much going to do what it does until the palladium stuff works itself out. Grains, soy, unchanged, offered at 1068. Corn, 423, up 5 cents. That's a surprise. Wheat, 615, up 10. Okay, so wheat continues to be strong, and soy has given up the rally for corn. Okay, let's get started. Those of you who may not know, I am an oil person. I'm a commodity person, actually. I'm a derivatives person, really, when you drill down to it. But uh, I've probably spent more time trading oil than gold over the years, although it's not my first love. So I'd like to talk a little bit about oil situation because there are two potentially big conflicting uh, factors influencing the market. So let's do that because it's going to help you see, I think, hopefully the next 6 months and the next 2 years based on how things are playing out. There's the homepage. Goldman, the secret buyer, has elevated prices and reset the gold relationship. Tuesday's PM posts and founders opening night for gold. All right, premium analysis. Why am I on that page? This is where I want to be. We're going to have to start with the current situation and then throw in the two news items. And we'll also have an extended version of this, really drilling down on the geopolitics of it at the end for premium subscribers. Prices are near the lows of their range for the past 3 years. That's a fact. Middle East tensions have done little to prop up prices until very recently. Also a fact. Israel's oil threat is real and very dangerous. We'll explain that in a little bit. Lower oil prices are good for the US, Europe, and China. They're bad for Russia and OPEC Plus, not necessarily bad for the Saudis. Government intervention is suspected of keeping a lid on futures prices. Term structure indicates some unnatural deferred hedging. That's my opinion based on evidence that kind of flushes that out. They did it in gold. They can do it in oil. Now, it's not 100% sure, but the market is not acting the way it should on term structure given its pricing power right now. Next, OPEC's solidarity is starting to slightly fray publicly. Not a big deal yet, but could be a big deal over the line, down the line. Threats from Saudi Arabia are usually serious, even if somewhat geopolitical fodder. We have a news item on that we'll share with you. Lower oil is, I think I already said that. Lower oil is good for China, right? Do we know that? No, we know that already. Let's go a little bit lower. Here's the bottom line. For now, the risk to oil is higher, not just from Israel-Iran risk, but from likely initial compliance by junior OPEC Plus members to the Saudi warning. Again, we'll get to that in a second. This also reflects max pain to CTAs. They're very short this market right now. Event risk warns of $5 moves either way. If war escalates, it really should be a $10 move if war escalates, or alternatively, if OPEC Plus frays more. So war escalates, you should pop $10. OPEC disintegrates, won't happen anytime soon. You drop $5 probably immediately. What does this energy price drop mean for miners? Lower oil prices is good for energy costs. That's not something I think is new to everyone. But this has been apparent for some time. That means mining shares are not attracting flows for a different reason. If that reason makes no sense, you buy them and get a nice dividend while waiting for a cap gain, depending on who you want. Because if they have extra cash flow and they're being run financially well, then they're going to either declare dividends or they're going to uh, buy their own shares back, assuming that they're running their company properly. Now, there are a lot, individual miners have a lot of variances, a lot of variations within them. But look, if mining is fundamentally undervalued, it is. Why is that? Well, one of the reasons is some management is not good. Some of them are hedging production, which is not bad. They need to hedge production, perhaps $500 lower. They have no more to hedge, but they're not disclosing that. And by not disclosing that, they're not letting you know what their hedge book looks like. And if the market rallies, only the really deep institutional dives understand that. Another reason they might not be rallying, well, they've been depressed for so long, and I believe that they're shorted by the banks as part of the uh, play to keep miners steady. Gold steady. Look, if you're long gold and you're short miners, you're making money because you're buying the gold cheaply from them. So that's like a carry trade. And there's other reasons as well. I think generationally, people don't, the next generation does not see miners in the way they should. And, they're not really a good industry at promoting themselves uniformly, not since the crash of the 80s and then the disaster of 99 with Ashanti and Cambior. But there's plenty of good miners out there. You just have to know where to look. All right, let's go to the news items circling oil. The first one, Saudi minister threatens price war to fellow OPEC Plus members. The kingdom called out members for overproducing in what was seen as a veiled threat of a price war. The statements were interpreted by other producers as a veiled threat from the kingdom that it is willing to launch a price war to keep its market share if other countries don't abide by the group's agreements, they said. Now you can read the rest of that. Saudis have carried out on these threats before, and they have advanced scalability and pumping ability that other nations do not. I'm not saying that they're head and shoulders above them anymore, but I am saying that you're witnessing the beginning of a fraying. I'm not saying it's significant. How it resolves itself is important, and we will discuss that at the bottom. Now, Israel says it's likely to target oil facilities. Israel's military is preparing a significant retaliation to the attack by Iran. They are readying significant response to Iran missile barrage and could involve targeting oil facilities. These are Iran's oil facilities. That's a very, very dangerous place to be messing around. That's the Strait of Hormuz. We will discuss that further at the bottom. But this is the Iran side. That's the Saudi side. And this whole area, this is where world wars start. We've never had it happen there before. But I'll give you an idea militarily before we get into it in detail later. The Strait of Hormuz, this whole area in here, and this island here, if there's a problem here, there's a big problem. And you can have a problem by having one ship sunk there. Okay. You can target that. There's also, Iran also has military over here. Okay. And the US has military out here in the ocean that could, probably hit a dime with a cruise missile. So, this is Israel doesn't have to hit anything there to cause a damage. They can also hit Saudi Arabia. And there's a lot of politics involved here. Very, very, very touchy. And oil is right to rally the way it has so far. Okay, we'll discuss that more. All right, data on deck today is ADP employment, which notoriously has been wrong, but you still can't ignore it. Uh, let's look at the charts for a second before I do the next part. All right, I do want to comment. We talked yesterday about RSI and gold. Remember what I said? We had a great day yesterday, right? Nice, completely engulfed yesterday's bounce. The other day sell off. So you have you have the whole thing, bull flagging upward, but now this happens again. And you're wondering, I think today is an important day. Everybody says a day is important, but today is an important day for continuation. If the day closes red significantly, like, more than halfway through here, if the day closes red, then I think we might break lower for a little bit longer. If the day closes here or higher, you know what? Then this RSI is going to say all systems go, which snowballs into the weekly. The weekly turns up, and the monthly already says ignition, you can go. And that's my view on gold. Silver, silver is look, silver just had an incredibly strong monthly close. There is more money that is coming. Any other month, there'd be more money coming into silver right now, plowing into it, driving it higher. But right now, we are in sell season. And although the market isn't lower, it just means there isn't as much buying. And I think the CTAs are a little bit too long right now. So I think, considering the lack of fresh money coming into this market, silver's holding, and by the way, and the selling of silver against gold buying, silver's holding up pretty well. Now, the catalyst for silver thus far and the next catalyst going forward will be China. China has another stimulus boost, and they're going to. If the market doesn't comply with what they want, they're going to do it again, right? This is the whole Draghi moment thing. And you're going to see copper run, you're going to see silver run, and then you'll see gold run. Okay, that's it. I'm Vince. Stay with us, and we will go through the premium section now. All right, everyone. Let's go to this. I'm on a tight schedule, but I want to give you the real deal here. Where am I? All right. First of all, we got a chart book in here. Really good charts. Where is it? Down at the bottom. You can take every market, but oil's in there, so I figured I'd throw that in there because I'm not talking technicals. All right. All right. Here's the part about OPEC that I want to start with. Here's OPEC is made up of weak and big and small nations, militarily and production-wise, right? So they have an agreement, and if you're not familiar with this, if you are familiar with it, just bear with me. You'll probably get something out of it. If you're not familiar with it, I think this will be very helpful. So within the agreement, everyone gets an allocation. You pump this much, you pump that much, you pump that much, and they all stick. But when countries are not happy with their allocation, why am I only pumping this much? As a percentage of how much oil I produce, that's a low market share. I want more market share. And the Saudis say, F you, stick to the plan. We'll get back to you next month. Promises aren't kept. The Saudis are in control. And then people start to cheat. Used to be Iran that would cheat all the time. I don't know if they're cheating. I don't know what they do now. But the cheaters, they get away with it, right? Instead of, stealing, it's like, they're like mice, oh, no problem stealing the cracker. No problem. And then more and more start to cheat, and you have basically a rebellion, and everyone starts pumping. And the Saudis, and everyone cheats all the time, no matter what they tell you. But the Saudis look at, they're probably cheating a little bit too, trying to but it becomes this. It's like a negative gamma situation in options. The lower the price goes, the lower it goes as far as they're concerned, because these countries have a higher cost basis than Saudi Arabia. I'm making it up. Let's say their cost basis is $60. It's not, but let's say it is. Saudi Arabia's cost basis is, let's say, $50 because they have better technology, et cetera, et cetera, et cetera. So all these countries, if the price goes from 69 to 68, they're making $1 less money as a dollar above 60, as opposed to the Saudis are making $1 above 50. And so they pump more. And they pump more because because they want to make more money. They need to make more money. They can't really afford rebellion in their economy. And so they start pumping more. And by the way, they're slower to turn on their pumps compared to, say, the Saudis. Maybe it takes them a day to get the Saudis just go like this. They press a button and the oil's flowing. It's done. It's out there. It's Saudi Aramco. It's like maybe the Russians have as good technology now in this way, but the Saudi setup, I mean, their oil's so shallow, et cetera, et cetera, et cetera. Okay. So now you have all these little guys, smaller guys, or feel like they've been mistreated. They start cheating. And the Saudis like, all right, this is starting to hit my bottom line now. Enough. What happens? Well, the Saudis say, this is the beginning of a negotiation. It's like, we're going to cheat until you give us bigger market share. And then the Saudis have to push back. They either push back by saying, okay, right? They're frenemies. They're not friends. They're frenemies. They either say, okay, let's talk, or they say, fuck you. You keep doing this, I'm going to press the button. And at $50, I'll break even and you'll lose money. That's what happens. Now, you're like, oh, that's crazy. They won't do that. Yeah, they've done it. They've done it in the past, and they don't have to do it that often to make a point. Are they going to do it now? No. All right. So let me just read through this. Small unhappy members are cheating. Saudi Arabia tries to keep them in line. The market share war escalates into a price war if not resolved. See, it's a market share problem internally that becomes a global price war. If resolved, allocations change to appease the smaller nations, right? If escalation occurs, the price will be set by Saudi Arabia, then smaller nations will comply and prices could go back up. I have charts to that effect. Where are they? Oh, there it is. I have it at the bottom here. All right. Here's what happened in 1999. It's happened before, but I know this so well, not because I lived through it. I mean, I lived through it, but I didn't understand it because I was very good friends and business partners with Peter Butel, who was the oil expert in the world. Uh, Son of Bill Butel, if you're a New Yorker. And Peter schooled me in oil fundamentally. He schooled me in geopolitics, and I would give him trade ideas and what have you. Okay, so here we go. This is the cheating. Oil is trading at about $24 on the highs here and under $11 here. Now, somewhere in here, they started cheating. And somewhere in here, the Saudis said, screw you, we're going to cheat more. I don't know why it rallied there. And they started to pump. And then here, in this month here, this is like a month, but it's really like a day. During this month, the Saudis said, if you're going to cheat, we're going to drive the price of oil to $11. Now, I may be wrong on my chronological order when they said that, but that's what happened. The price of oil went to under $11, $10.82. And you know what magically happened? They all said, we're done cheating. Because at the time, Saudi's price cost was like $11. Like, fuck it. We can survive. And this is the same chart. This is them complying. It's like, okay, we give up. And then this is they get their shit together. And you notice that this is like whenever you see the 45-degree angles, it's man-made behavior. It's not random behavior. Like this isn't man-made, but this is one organization acting in unison. And this is a bunch of people just kind of like sneaking behind their backs. And that's what happens. So when you hear them say, we may abandon production cuts, you're like, why would you do that if oil's lower? You're doing that because you want oil to get lower to get these cheaters in line. Okay, next point. Lower oil is good for China. Look, I personally think that there's something going on here. It's like I think China and U.S. are overseeing a divorce, a global divorce. And China's like, listen, the dollar's too strong. You're screwing us, right? You're screwing all the BRICS. And U.S. is like, all right, listen, we can't have the dollar I'm making this up, right? We can't have the dollar get crushed. But listen, how about we let the price of gold go up? I know you guys got a lot of gold, and why don't we do that? I know you guys are kind of like doing a soft connection to gold and your BRICS thing. And they're like, fine. And I'll tell you what we'll do. We'll do our best to keep oil down. China's no dummy. China's like, all right, we'll take that, right? China's like, okay. Russia's their partner. But Russia's also long gold. So overall, you can say that it doesn't hurt Russia and it helps China. It really hurts Russia too, because Russia is very revenue oriented. Russia is a cash flow country. They pull it out of the ground, they sell it, they make money. China is a manufacturing country. They pull it out of the ground or import it, They add value to it and sell it. That's the beauty of being a of being a manufacturing economy versus a natural resource economy. You're so much more dependent on cash flow in Russia than you are in China. And there's pros and cons to that. Okay, so for now, the risk to oil is higher, not just from Israel around, but likely from initial compliance, right? Okay, let's go to that part. Uh, where? Oh, there's the first one. All right, so I showed you what the Strait of Hormuz looks like. That's in this little red rectangle here. All right, here's the war right now. The war is in the pink rectangle. There's no oil there. Okay, the oil is in Iran. The facilities are here. There's oil in Iraq. There's oil. They don't need to hit Iran. They could miss. Not that they would, but they could miss. And I mean, all you need is some debris falling into Saudi Arabia, blowing up a well. And you don't need there to be a hit for there to be damage. Look, if I run an oil refinery and I know that bombs are going to be flying overhead, I'm going to turn it off, right? It doesn't take much to destroy a refinery now. When Saudi Aramco went public, they had a problem to that effect. Probably manufactured, but hey, you never know. Okay, so that's it. This is geographic now. Once they start shooting missiles this way, all bets are off. Like this is a big problem if it happens. Now that's what the U.S. does. We make sure Israel doesn't screw that up, and Israel has the technology to make sure they don't screw that up. The U.S. puts ships over here to mess with anyone who even thinks about attacking this area. And of course, they're not going to do that with Israel. They'll probably talk them out of it. The Saudis have plenty of weapons too. And Israel can't fly over the space. Israel can't just like fly over Saudi Arabia and bomb it. They've got to go around. I don't know how they do it, but they have to do it. We can't let them fly over Iraq, right? But you know, this is where it becomes an airspace game for them. Anyway, so there you have it. That's that portion. The futures portion. All right. Term structure indicates unnatural deferred month selling even while spot term remains relatively firm. Okay, the term structure of oil. These are the months that I'm showing here. That's December, March, June, Sep, and Dec. Those are the quarterly months going out from 24 to 25. And you'll see that spot is higher and it goes lower as you go further back. And that's called backwardation if you're not familiar. And backwardation occurs when there's more demand in the front month than there is deferred. So we need the oil now. We don't need it next month, right? Simple enough. Now, there's one thing obviously affecting oil now. Now, oil will backwardate with the fronts going over the backs for any number of reasons. One is geopolitical risk. We're experiencing that right now. Two is true demand because of crackers have to stock up on oil for heating oil season or gasoline season. That may be happening right now. I don't think so. I would check with someone else on that on the timing. You have to look at the crack spreads. And the third reason is hedging. See, when producers hedge, they don't hedge the front month. They hedge a year out. Now that's not going to that's not going to make the fronts go over the backs. That's going to make the whole thing drop. But when the backs are going down and the fronts aren't complying, well, let's say that you're a financial organization and you wanted the price of oil lower, but you didn't want to make delivery of any oil because that's your spot contract. So what'd you do? You would sell as many as you can in a deferred contract and hope that the selling that you do out 1 year trickles forward and hits the rest of the market. Me, as a futures trader, if you were to sell me, let's say, D's 25, red D's we used to call it, I'd buy red D's 25 and I'd say, well, shit, that seems cheap. Let me sell something against it. And I would sell front month D's. I wouldn't always do that, but I would do that, right? And I'd put a spread on and I would bet that that spread would converge over time. Okay, well, guess what? It's not converging. And that means no one's selling in the front. And that means the sellers aren't really selling it to people that want to hedge. I guess what I'm saying is a backwardated curve is an indication of demand in the front and or supply in the back. If it's demand in the front, it's because of seasonality, or it's because of I think there's going to be a problem because of the war, and therefore I want to stock up, right, for the season. All in the market right now, and the other reason is supply. Someone is hedging in the back. I don't know that anyone's hedging right now. You see, a lot of the producers are committed to giving oil back to the SPR right now. Okay, so when Exxon or Chevron says we're giving oil to the U.S., the U.S. is purchasing oil for the SPR. That's not new oil being purchased. That oil's already been purchased per the agreement of the SPR being drained before. Some of the oil was a loan, so they're giving it back. So, I could just imagine the U.S. is getting SPR oil back from Exxon and saying, "Fuck it, let's sell futures against it." The U.S. is horrible at this. We hedge spreads the wrong way in the SPR when it could be a moneymaker. Anyway, so that's it. I'm going to look for more evidence of that. I'll look for some reports, but that's how it goes. So let me see if I touched on it all. All right. So Middle East did that. OPEC, the dynamic there did that. Pricing did that. Positioning. Okay, final points. Before the kingdom makes good on any threats, multiple warnings are given usually, and this happens over months, not days. One can neither ignore the geopolitical implications of these threats in any election year also. Cannot, right? There are always chess games going on with the Saudis. They're pumping oil to get jets. They're pumping oil to get kickbacks. The Saudis, stop it, that's my dog. The Saudis are the mafia. They're a capitalist mafia. They're not a country, okay, with a lot of family members, right? All right. There will be back and forth. Russia is key in this way. Now, war, nothing, as I said, nothing has to be destroyed for oil to go up. The threat of destruction makes refiners shut down, which may have an effect immediately. China's new influence over Iran, Saudi Arabia. I'll let you read that. Positioning. CTAs are very short oil and gold. Absent news, if there's no news at all, they will cover oil as November and December buy season comes for RAs. Bullish news they will cover. Bearish news they will still sell, but smaller. I'm Vince, by the way. I'm slightly low oil and I'm just breaking even right now. Have a great day.